All right. I think we kick it off. So yeah, again, for those that have joined us, thank you for joining us live. And for those that are watching the recording later on, thanks for also watching it. Hope you take some stuff from it. So today what we're going to do is we're going to go through a webinar regarding superannuation, tuning that up, and how your insurances within those funds affect that, and different things to consider as well.
Per usual, for all these finance stuff, I'm sure you're well used to seeing these disclaimers by now. We have one too. Just to let you know that the information in this webinar is general information only and should not be relied on when assessing if your policy is right for you. Please make sure to always read your own insurance policy product disclosure statement for confirmation on any info that we've provided during this webinar.
So what our agenda is for the night. So we're going to go through what is superannuation, what actually happens at retirement, why people should care about your super, not just at retirement age. It doesn't matter now if you are a lot younger and earlier before super. Why should you care? What to look for in a fund, multiple different things to consider about why a fund should be right to you, and where to go to get that advice, whether you do it yourself, traditional advice versus digital advice. What are the things to consider there? And what insurance options are there in super?
We're also going to be looking at the difference between holding your insurance inside of your superannuation or outside of your superannuation, what the major differences are between group insurance and retail insurance. And then we have some case studies based off of some Skye stats around the differences between group and retail. And at this stage, we're going to ask a few questions and give away some prizes. So stick around if you want to be in it to win it. And then we will finish up with why advice on insurance is important and some Q&As. So if anything comes up during the webinar that you wanted to ask us, just chuck it in the chats and we'll get to it at the end.
Awesome. Let's kick off. So what is superannuation and what actually happens in retirement with this bucket of money? So you can look at super as two different things. So there's the bucket that you're filling up during accumulation phase. You're putting as much water in the bucket as possible so that you, come retirement, can turn the tap on and then, well, you've got a bucket of water, but your bucket of water now turns into a tap and then you can empty that tap out. So maybe your bucket of water is actually a tank. Now you can empty that water out into retirement, making sure that you can use it and live the life that you can. So there's multiple reasons why looking at your super now is appropriate. There's tax effective ways of saving and for your retirement and into the future, whether that's contributions where you're saving on the tax that you would there, as well as the investment itself. The super side of things is typically taxed at 15%, where most people's tax is looking anywhere between 30 to 48% in the most part. Your super is typically preserved until age 60 as well. So you're looking at all the way through to age 60 before you're being able to access it. And then everything after that is where you're looking to use it.
So if you're like me and you've got 30 plus years left until retirement, you're probably wondering, why do I need to care about my superannuation right now since it's so far away until I'll be able to access it? Ooh, there we go. It's really important to remember that the superannuation is your money. Come July, 11.5% of your income is going to be being paid into superannuation. And so this is money that is your own, you are earning it, and it is being invested for you for your future. Superannuation is also a really good tax effective way to be investing, and it will help you. You can use it to save for your first home through the First Home Super Saver scheme. But what we're going to be talking about a little bit more throughout the rest of this webinar is how you can use your superannuation to cash flow your insurance premiums.
Awesome. So what to look for in a super fund? So there's multiple things to look for in a super fund. It's not just the top line fees. Is it the investment returns? Is it the badge that's on the front? Is it the one that your industry is typically with, or is it the one that your parents are with, or maybe your friends and family? There's lots of different things to consider. And what the things that we look to consider are, is the first one is the fees. We want to make sure that that's low fees, so that you're keeping more of the funds in your super fund for your retirement. But that's not the be all and end all. If you have a really low fee super fund, but the actual investment options aren't there, that's something that's not going to be great. At the end of the day, you're investing potentially over the next 40, 50 years, even into retirement as well. So it's not getting to age 60, age 65 and then withdrawing it all. You've still got that next 20, 30 years, depending on how long you live, to have your investment in there as well. So the investment options themselves are going to be very important for you in different life stages throughout. That's also going to come into your performance as well. So investment options, but the actual performance of those investment options, does it have the right risk tolerance, but also is it performing? And then that again ties into the fees. So you can look at all those three together. And then you're looking at the insurances as well, which we'll talk a bit about today. But yeah, you can get insurances through your super fund, or you can get them externally as well, but it's also something to consider.
So you're probably wondering, where can you go if you want to get advice on your superannuation? Traditionally, advice on superannuation was only available by going to a financial advisor, who would then provide you advice on your superannuation, your insurance, your investment options, the whole suite of everything in your finance world. And this would cost you upwards of $3,500. Yes, said that right. So these days, there's a few more options if you want to get some superannuation advice. You can go direct to the super fund, but it's important to remember that if you're going directly to the super funds, they're not going to be providing you advice on how their super fund stacks up against other funds. They're only going to be able to provide you advice on what your investment options are, contributions, and nominating a beneficiary. If you are really into learning and doing lots of research, you could go DIY. Or there's a quite relatively new opportunity these days through digital advice or robo advice, where you just put in some key details about yourself and get some recommendations that way.
Okay. So what are your insurance options? What are insurance options are there through your super fund? So there's multiple different insurances. There's not all the insurances, because often the super has different laws than outside of super on how things can get paid out. So there is a few limitations on what can be offered. But the insurances that are available through super are life or death insurance, is often called, which will pay you out if you were to pass away or become terminally ill. What we'd typically use that for is to replace your income, passing on support to your family, clearing off a mortgage, and covering any funeral costs that you may have.
Next up, there's total and permanent disability cover, which pays out a lump sum benefit if you become totally and permanently disabled and you're never able to work again. This is typically used to replace some of your income, the gap that your income protection isn't covering. It's often used also to clear the family mortgage, as if you've become totally and permanently disabled, you don't want to have the bother of the family mortgage over you anymore. And it is often used to cover any medical costs or modifications to your home or car or wheelchair if needed.
Awesome. And our last one is our income protection, looking at paying your monthly benefit if you're unable to work due to injury or illness. So as it sounds, it's covering your income, making sure that you can cover your monthly, weekly, annual expenses as you're unable to work. And that could be over a 2-year period. It could all be all the way through age 65, depending on what your policy is.
So what is the difference between having your superannuation inside or outside of super? As Trent mentioned, there's different, the covers are available in different ways inside and outside of super. But to start off with the good, having your insurance through your superannuation means that there's going to be less impact on your personal cash flow. It's important to remember, though, that it is still going to be impacting you financially. regardless, because it's still going to be drawing down on your retirement savings in the future. It's also another pro of having insurance in your superannuation is that it can be it can be quite cost effective if you're just on the default levels through the super fund. But if you were then to go to the super fund and increase your cover with them, it's often a bit more expensive that way. And then if you're having the default, there's often limited or no underwriting required to go and get that cover. So it means that you can get a little bit of cover through the default of your superannuation a little bit easier. Another con with insurance through your superannuation, though, is that come claim time, there are different conditions required to be able to release funds from your superannuation if you're going to be releasing it early, as in before you're 60. And there's often a bit of tax related to that compared to if you were going to be paid the lump sum personally to you outside of superannuation. The final good point of having the insurance policy in your superannuation is that you can superlink the policies, and so it can be connected to your policy outside of superannuation. On the bad side, though, there are often limitations to the terms and conditions that are attached to the group policy. So the terms might not be as favourable if they are purely through the group cover that the superannuation is offering for you. And as Trent alluded to earlier, there's no trauma cover available through superannuation because of the definition, because of the scenarios in which you will be getting paid out for trauma cover. They do not meet the conditions for releasing the funds through superannuation. And so we didn't mention trauma cover earlier, but it is paid out if you are diagnosed with one of around 30 to 40 illnesses, and they typically include heart attack, stroke, and cancers.
Awesome. So, ¿por qué no los dos? Why don't we have both? So we can do both. We can have the retail policy that's both inside super and outside super, getting all the features that we want, whilst also using your super to pay for it at the same time. So there's a few different things that an advisor can help you out with doing that going directly to your super fund isn't going to be able to achieve. So group insurance or retail insurance, we've got a few different slides here going through the differences and what we think is pretty good reasons to look at retail insurance cover.
So what are the major differences? So there are sort of four things that we see as differences around: the insurance options, payment flexibility, the ability to change the policy, and the cost.
Awesome. So the first one is our insurance option. So if you were to go directly to your super fund and get the group insurance held within your super fund, you're going to be restricted to one insurer only. So what happens is with these super funds, they'll take their insurance book out to tender every 5 or 6 years, depending on what their contract is, and you'll only be able to get insurance through that one provider. Versus if you were to go with a retail insurer, we've got over 10 different insurers that we can use, depending on your needs and your current health, your occupation, your age, the levels of cover. It could be one of those 10 insurers would be the best insurer for you. What we're able to do with that insurance is also just then get paid from your super fund. So with a group policy, your super fund is your super, and then you have your insurances within that. If you want to move your super fund, you have to move your insurances with it. You have to cancel it, take out your policies elsewhere. And if your health has changed, you might end up with exclusions and all those sort of things. Where with the retail insurance, if you're holding it within super and you've got your super fund paying for it, if you change your super fund, we just need to update that insurance company. Hey, this is where my super's now is because I've gone through and I said, I want the investments of that super fund. The fees are better, whatever it may be that you've come up with. Can have my other super fund pay for it. And what they'll do is just take the insurance premiums from that new fund and keep your insurance policies the same. You don't need to go through any new medicals and things like that. Awesome.
So that's basically that slide. Do you want to go to the next one?
Awesome. I just talked through both slides because Phil was meant to be doing this webinar, of course, and I got subbed in last minute, and I obviously haven't read as much as what I probably should have. Do you want me to do this one as well, Ash?
Yes, please.
Awesome. And then we have the policy change. So between a group policy, typically when they tender their insurances, the insurance company that then wins the tender may change the policies as well. And that could happen at any time. So your policy, you may be covered for certain things, and then the insurance company decides, no, for people age 40, we don't want to cover them for $500,000 of cover anymore. We're going to make sure that decreases over time so that your cover is just going to decrease because that's what they feel they want to do. They may say that they don't want to cover for X illness or X condition, and you're not covered anymore, no matter what you've been paying for previously. Where a retail policy is what they call guaranteed renewable, where if you take out a policy today, they can't make the terms any worse. They can make them better. So usually when they make them better, it's to do with upgrades of medical assessments and things like that. But they can't say we're not covering you for X amount of things or we're just cancelling your policy altogether purely because they want to. So as long as you keep paying your premiums, your policy will remain in force if you have a guaranteed renewable one.
And then that brings us to the difference between the cost of group and retail insurance. And so this is quite a tricky one for insurance. It's not the same as superannuation where you rock up and you're like, hey, how much is this going to cost? And they can just show you their fees that are dependent on your investment balance. With insurance, it comes down to lots of things such as your age, gender, your occupation, any health history. And so what we've done here at Skye is pulled together some stats from our last 500 clients to have a little bit of a case study and comparison from a real life, what the difference in costs are.
Awesome. So we're going to announce or hand out some prizes. So Ash, do you want to put the question in the chat? So of our last 500 clients, what do you think the percentage difference in cost for group cover compared to retail cover is? So as you can imagine, we're probably not going to be talking about this if group cover was to be cheaper than retail cover. So I'll give you a hint. The retail cover is actually cheaper than group cover. What percentage cheaper are we looking at? Is it 5%? Is it 10%? Is it 100% cheaper? Put some answers in the chat, and closest to the pin will win our prize.
Here we go. Lots of answers coming through. We got 20%, 17%, 7%. Bronwyn's gone a bit crazy, 60%.
There's a few good answers in there. Do you want to let them know, Ash?
So our answer is 33%.
So we had someone right on the button. We've got Jasper right on the button. And our next closest from there is Skye on 37. And who's after that? Mel on 25. So I think we might have a few prizes to give out. And we'll get in contact with the winners. So I think we might have 3 prizes. So we'll have Jasper, Skye. If that's not Skye Advice, I'm hoping it's not. And Mel, we'll send you. We'll get in touch with you after this. So well done. We've also got a poll to chuck in the chat as well. So what we've done is we've got 5 separate insurers that we looked at, or 5 of Australia's biggest insurers. Awesome, Skye. It's good to see. It's not one of our staff trying to steal a prize. So 5 of Australia's biggest insurers, and we've got a bit more of a deep dive into the cost comparisons for those guys. But yeah, can we put our poll in the chat, please? And we just want to find out if anyone is specifically with these super funds. So if you are with any of these super funds, give us an answer. If you aren't with any of these super funds, try not to answer it. We couldn't, the maximum amount of poll answers is 5. So we would love to have a 6 to say I'm not with any of these, just so we can get you to answer. But yeah, we'll give everyone a couple of minutes or maybe a couple of seconds to answer, and then we can talk about it in a bit more depth.
So far, we got Australian Super in the lead, which makes sense.
Typically Australia's biggest super fund. Couple of answers for each, except for Cbus. So no tradies in the building today. They must still be celebrating their agreement yesterday where they all got a pay rise over the next couple of years. So let's kick into gear to what we're going through. Do you want to go to the first one, Ash?
Oh, I was going to get you to go first.
I can go first. So basically what we've got here is 3 different areas. So we've got overall average. So this is, again, our 500 clients. Don't know the direct amount that make up the Australian super ones, but there would be a few. As we can see, it's the highest covering answer in ours. So on our overall average, Australian Super's insurance, when we're recommending the levels of cover that we want to recommend, so the larger sums of life TPD and income protection that we think our clients need, if we were to take out that cover with Australian Super, on average, it's going to be 46% more expensive for exactly the same levels of cover. Our lowest price difference, so we want to make sure that we're paying the right pitches. There was a client that was cheaper. It was 60% cheaper than the retail cover, but our highest one was $376, 376% more expensive than the retail cover, which was, gobsmacking. Was that the highest, Ash, of our numbers? In terms of, yes, our highest point difference was 376% difference here. Yep.
Next up, we have Australian Retirement Trust. And so on average, they were 15% more expensive than the retail cover. Their lowest average, again, is hovering around the 67%. And their highest one is 238%, which is quite high as well, just not quite as high as Australian Super.
Yeah, so your major big differences in terms of prices usually around a higher risk occupation. We get big differences in those heavy blue collar roles. A lot of the super funds will really drive those prices up, and there's often an insurance company that's willing to take them on at a lower rate and reduce their premiums is typically the way we look at it. Then we have Aware Super. So Aware Super is actually the one that their insurance premiums are typically lower. So they're actually 15%, but in the lower side of things than the retail cover. Would we then go put everyone with Aware Super? No, it's still the case that there are other things to consider than price, the features, the benefits of the policy. So it's not, hey, Aware Super is cheaper, everyone should move to Aware Super and go with that. There's obviously the investments inside the super fund and the features of the insurance company. So it's not everyone rush to change that, but it is something to point out that their insurances are typically cheaper than the retail cover by about 15% off our 500 clients. The lowest difference was 67%, but they still do have those higher ranges. So 163% was one of our clients. So again, it's really a case-by-case basis.
Next up, we've done a comparison for Host Plus, who on average have been 25%. Their cheapest gap was 54%. Yeah. And so for this client, we have, again, recommended that we are replacing it, but that's for situations like there might be no exclusions on their policy. And as Trent was saying, that the features are often better when it's outside of superannuation, not in the group policy world. And then for the highest price difference for Host Plus, we got 261%, which is quite high.
And now our last one, which is quite extreme. The overall average, which is our highest overall average, was 133% more expensive with the group cover, which is quite astonishing. Often is the case, I'm pretty sure it's still the case, is Cbus don't offer income protection to manual employees either. And when you're thinking about Cbus as a general rule, most of your employees are going to be tradies on the worksite. So a lot of their cover isn't actually covering them for the right things like income protection that we think is pretty vital. there was still a client that was lower price point, so 61% better off by in terms of premium by staying with Cbus. But then our highest one of 200.
And I'll jump in here. I have the numbers in front of me, and most of them, there's been sort of a bit of a even split, with some have been cheaper, some have been more expensive. Whereas for Cbus, there's only been 3 clients where it was cheaper, and probably about 20 of them where it was more expensive. So very big difference in the numbers for Cbus.
Awesome. And yeah, that big one of 284%, from $3,000 to nearly $11,500. Yeah, it's a pretty big jump.
So after all of this, you may be still pondering, why is it important to get advice on insurance? But I think the important thing to note with that last slide, with the last portion of what we've just gone through, is that the premiums are often a lot more affordable if you're going and getting insurance outside of superannuation. And again, as Trent hinted, the features are often more favorable outside of superannuation. You can get sort of different definitions, and yeah, a better policy outside of your super than if you're going to go chat to an advisor.
So some case studies from our last quarter, or last 500 clients, I believe, was it, Ash? So yeah. With our last 500 clients we looked at, we made 496 recommendations. So I believe 4 of those probably were declined insurances up front. So we couldn't make a recommendation that we thought was going to be suitable because they're going to get declined all the covers. So yeah, we've been probably sort of with a few different webinars if you've checked in, but we don't like to get a lot of health information up front so we can figure out exactly what's going to be best case for you as well. So it's not just price-based or features-based, it's going to be personalized in that space as well. So of those 496 recommendations, we told 202 of those to alter or keep their current cover, usually because of those health reasons. We told 195 to replace the current cover because we thought it was going to be in their best interest. So what's that, about 33%, roughly, a bit less, a bit more. About 40% of our clients were telling them to, hey, your current cover isn't the right one for you, upon our opinion. We think this insurance company is going to be better for you. And then 99 have no cover, current cover. So that was 99 people come to us and didn't have any cover. So we couldn't make a recommendation to keep or cancel because they just simply didn't have any cover within their super fund or elsewhere. So we're just making a recommendation on where they should be. And our last, I think this is our last point of the evening, is you and your ability to earn income are your greatest asset. So often people will think their home, their superannuation potentially, if they're getting older, is their greatest asset. But typically in this lifetime, your greatest asset is earning an income. So the last webinar we ran last month, when we handed out a prize for this, is on average, the average Australian will make about $5 million per year, per lifetime in income from age, I think it was age 18 to age 65. And that was off a base salary of around $65,000 increasing with inflation. So not exactly a drastic income, but yet $5 million, most people wouldn't consider that to be the number of your income moving forward. So most people will insure their house, their car, their contents of their home, but do people need to insure their income? I think that's a resounding yes, but most people don't. So we're out there putting out the good word. Awesome. So now we've got as much time as we need to go through any questions that you do have. So put them in the chat as Maria has, and our team will flag them as a question. We'll bring them up and answer them as we go. Do you want to take the wheel, Ash, on the questions?
Yeah, sure thing. So far, the first question we've got is, how do premium comparisons between retail and group influence decision making for individuals seeking insurance? So maybe I'll have a first crack and you can finish up by the rest of my answer. So when we're having a look at it, premiums definitely factor into things, but we're also having a look largely at if there's going to be any exclusions on the policy because of health history, or if maybe you come to us and your super has no exclusions on it, then we're going to be looking at retaining that insurance because because you may already have a back exclusion or mental health exclusion. Those are probably the most common exclusions to have. And so it's not just the premiums that come into the decision.
Yeah, it's typically go with three things: health, so features, and price. So health first is typically where we'll look at. If there's an insurer that's going to cover you for certain things when other insurers wouldn't, we're probably going to make a recommendation on that, even if they are more expensive than other covers. Next one is your features. Are there certain things that we deem to be important? We didn't really touch on it today, but there's lots of different things we can add into an insurance policy that could make it better than the next and more important to one person or the next. And then the next one is an overlay of price. Yes, we don't want to be recommending insurances that are drastically expensive. If there's an insurance policy that's going to be just as good, that's going to be cheaper, but on the same scale, we don't want to be recommending an insurance policy that's really cheap, but it might be nasty as well. So there is that happy medium of finding that happy ground of we can afford this and they have all the features we need, but it still has all the features we need.
Cool. So the next question we have, and I'll get you to answer this one, Trent, is what should you keep in mind when choosing the beneficiaries for your superannuation?
Good question. So there's a couple of things. Obviously, the first one is who do you want to have your money once you pass away? That's that's the biggest one. Making sure that it's ending up in the pockets that it should, for the purpose that it should. Especially if you've got your life insurance through there, we're making sure that we're nominating the people that it's going to go towards, and that might be young children. So then that's looking and going, well, if I give a young child younger than 10, or even up to 18 or even up to 25, I probably don't need to have money as a 28-year-old, to be honest, at the same time. So it could be of any age. You're probably looking and speaking to an estate planning lawyer so that you can set up a testamentary trust as well. Hey, if I pass away, my children are going to be looked after by X, Y, and Z, and there's going to be a lump sum amount of money there. I don't want that person to get that money at this point in time. I want my child to have it when they turn 18, X, Y, and Z, and you can work that out with an estate planning lawyer that can make sure that your wishes are taken care of, because the last thing you want to be doing is obviously passing away, but the second last thing you want to be doing is passing away and then watching your money and what your plans were for the rest of your family and your money's life be completely squandered somewhere else. So that's probably something to look out for, is finding out where your money should go, but then speaking to a professional as well, because there's a lot of things that can go into it.
Fabulous. The next question we have here is there a rule of thumb on how much your premium should be, and how do you know if the recommended premium is too high or too low, assuming the cover is all good? So here at Skye, the policies we're recommending are often held inside of super and outside of super. And so outside of super, coming from your personal cash flow, most commonly we see is an impact of about 1 to 2% of your gross income. And Trent, I can't remember what our common percentages are for inside of your super.
Depending on what you have in your super. So if your income protection inside super, you're probably looking at somewhere between 20 and 35%. Sometimes we get up to 50%, depending on age and things like that, and levels of cover, whether there's loading, things like that. So 50% is the highest we typically go with without starting to change our advice. Most people between 20 and 35%. outside super. So that's of your super contributions per year. So if you're earning $100,000, your employer is putting in 11% at the moment, 11.5 soon. You're getting 11 grand into your super. So 20% of that is somewhere around 2.5 grand. That's our rough estimate between that and 35%. Then outside super, anywhere between 1 and 10% is reasonable, but we get mainly between 1 and 3%, and that's of your gross take-home income after that. So, it will change between who you are and all that sort of stuff, what life stage you're in. But yeah, those are the parameters we will typically work with.
And then a question from Bronwyn. If you are looking to increase your insurance, does that open an opportunity for the insurer to reassess your health and introduce exclusions? So from what I understand, and Trent, you please correct me if I go astray, is that the insurance that you already have, so before you go and make any increase, that cannot be changed. The insurer cannot change it to make the situation any worse for you. But if you go and go to put an increase on your insurance, then they'll ask you all the same questions from the beginning, and just the top-up amount could have new exclusions on it.
Yeah, that's exactly right. So if you had, let's say, $1 million of life and permanent disablement with no exclusions on it because you took it out when you were 20, 25, even now or when you're older, 5-10 years later, you decided that, hey, I'm going to go back and play sport because I think I can still play, and you hurt your back or hurt your knee, and now we're expecting a knee exclusion on your policy. Any cover that was taken out pre that incident, the insurer won't be able to backdate any exclusions. And if you go and say, now I've got $1 million of life and TPD, but I actually want $2 million, when they reassess you, they'll only assess that new $1 million. So what they'll say is the first $1 million of permanent disablement has no exclusion for your knee on it. The new $1 million has an exclusion for your knee on it. So if you were to be never able to work because of your knee, you're going to get $1 million paid out, but your other $1 million won't pay you. Like, you're on mute, Ash.
Rookie mistake. Are there any steps to take if I want to change my insurance provider within my super fund?
So I won't answer this one. The first one's probably, I guess, might be a bit selfish, but speak to Skye or speak to another financial advisor, and they'll be able to take you through all the sorts of different options that are available to you. So that way you can figure out, hey, is the policy within my super fund the right one for me? Comparing super funds in terms of their investments, their investment costs and things is relatively straightforward, I guess. And you can probably do that over a glass of wine with your computer and go through all the different performances and the fees and things like that. The insurances themselves is probably a little bit hard to do yourself, I think. Health reasons, occupations, ages, figuring out what levels of cover are on these super funds, and then the costs themselves can be pretty hard. I would suggest that it's best to speak to an advisor. But if you want to do it alone, getting the PDSs is probably the first step, going through and figuring out what the costs are, what's covered, not covered. But yeah, we use a few different programs to compare our insurances, and a lot of different tools and different providers. There's a fair bit that goes into it, to be honest.
All right. Any more questions? Nothing else has come through.
Give them a minute or two in case there's any last minute questions. We're on the clock, 5 seconds, and we'll keep moving on if there's no further questions. Here we go, one last one.
What are the pros and cons of setting up your own super fund? Oh my goodness, that is above my pay grade.
Now that is a kettle of fish. So basically setting up your own super fund, I assume might be self-managed super fund. You can still hold your insurances, and let's talk about insurances within your self-managed super fund, because the investment side of things is not Skye's kettle of fish at all. We leave that to the self-managed super fund pros and the investment pros. So when you're looking at insurances, your insurance options are very similar to having your super fund with, say, an Australian super or any other super fund that we've had, but you don't have that default level of insurance or that direct insurance company with the super fund. We're still able to get all the retail covers that we're looking to recommend typically through those super funds as well. So it might be something, if you are opening a self-managed super fund, that, hey, insurance is something that you should look at because you're moving away from one of these super funds that you had your insurances with previously. We would always say, let's look at your insurances before you move super funds, because you can't go backwards with your super and go, hey, I actually wanted that insurance previously. They're going to cancel it and you're going to have to take it out again. And they'll ask you all the health questions and things like that. And that all the dates and things like that will change, which will lose some of your benefits. So, if you are looking at moving to a self-managed super fund, I would say, or any super fund really, if you're looking to move your super fund, look at your insurances first, then look at the super after that to make sure that we're capturing the right insurances for you. And then you can look at your investments after that. Maria, can I choose the advisor I want to speak with for advice? So typically at Skye, the way we do it is you can book in a call, and I'm sure that's probably one of the next couple of slides. It isn't, but you can book in a call with one of our advisors at Skye. Typically, that will go to the advisor that's most available for you at that point in time. We don't typically take requests on who that advisor is going to be, because different workloads will be busy at different times. So typically what we want to do is get you into the advisor that's going to be able to get it done for the quickest. But if there is someone specifically you really, really, really want to work with, let me know and I can sort of figure that out. It's going to be a quick thing, whether you're going to have to wait a month or two and it's going to be not worth your time. So feel free to reach out. If it's not Skye specific and it's business wise, you can, basically you don't need to be with any specific advisor to get any specific product. Most insurance advisors should be able to get any of the insurance products that we look to recommend. It just comes down to, who's going to be best to work with you. Awesome. I think that might be our end of our questions. So thanks for joining this webinar today. We've got a couple more slides to go through. We're having another webinar on the 23rd of July on the Tuesday again, that's 7 p.m. It's going to be on insurance refresher. When do you need to update your policies and when to get one? Reviewing your policies. When should you need them? What are the life events that pop up that insurance are needed for? So it'll be a good topic. And I believe Azaria and Mark will be on that one. I'm hoping that both Azaria and Mark are healthy, so I don't need to step up again last minute. Do you want to take us to the last slide, Ash?
Happy to. So we really love getting everyone's feedback. We love knowing how we can improve and what we can do to make sure that we are giving you the content that you want and answering all the questions that you have, everything that you'd be most interested in. So after this, you'll be automatically redirected to our survey form. And if you could please take a couple of minutes to fill it out, that'd be much appreciated.
Any feedback's good feedback, whether it's good, bad, or otherwise. And if you want to comment on my Spanish lesson, you can do so as well. So thanks for everyone for joining us tonight, and those who are going to watch the recording later on. As always, if you do have any questions, feel free to reach out, book a call with one of our advisors and we can go through anything that you need to know before taking out any insurance policies or reviewing your current policies that you do have. Awesome. Thanks, guys. Have a good night.